Welcome to all of you, Shiksha 360. And today, basically, we will discuss chapter number 8. Let's discuss chapter number 8, that is monetary policy and fiscal policy. Clear? That is monetary policy and fiscal policy. This is very easy topic with respect to the other topics. And basically, we will expect 2 to 3 questions basically from that topic also. Clear? 2 to 3 questions basically from that topic also. Basically, in this topic, clear, in this topic, basically, we have to just understand, clear. Basically, we have to just understand basically how these things, clear, basically, how these things, clear, basically, like monetary policy and fiscal policy, clear, play their role, clear, how these policies, clear, basically, play their role. And basically, we will also discuss what is the difference between the monetary policy and the fiscal policy, clear, and what is the difference between the basically monetary policy and the fiscal policy, clear. Can anyone tell basically what is the basic difference between the monetary policy and the fiscal policy? Clear? As you know that basically monetary policy is to be released by the MPC, clear, that is Monetary Policy Committee, clear, that is Monetary Policy Committee. It is a 6-member committee, clear, it is a 6-member committee, and the head of this committee is the RBI governor, clear, is the RBI governor. Clear, sometimes they will ask, like, I will tell you basically in the year 2021, September, clear, in September, basically when JAB exams held, clear, they ask directly one mark question, straightforward question on the monetary policy, clear. Basically, they directly ask basically what is the repo rate up to, I think in that basically at that time basically they have asked the data up to December 2020. So basically they have asked basically in the December 2020 what is the repo rate, clear, what is the reverse repo rate, clear. Sometimes they will ask these types of question also, clear. Sometimes they will ask these types of question also, clear. So basically we have to aware regarding all these things. So let's start, and first of all basically we will discuss basically what is the basic difference between the monetary policy and the fiscal policy, clear, monetary policy and the fiscal policy. First of all basically we will discuss here basically what is monetary policy, clear, what is monetary policy, clear. So basically monetary policy it is the process, clear, monetary policy it is the process by which the government, clear, basically monetary policy it is the process by which the government, central bank, clear, by which the government or the central bank, clear, by which the government or the central bank or the monetary authority, clear, basically, or the monetary authority, clear, by which the government, central bank or the monetary authority of a country controls, clear, basically what they control, clear, basically what they control here, basically what they control here, basically they will control here basically the supply of money, clear, basically monetary policy it is the process by which the government, central bank or monetary authority, clear, basically monetary authority of a country controls basically what they control. First one is the supply of money, second one is the availability of money, clear, basically supply, if there is increase in the supply in the market or decrease, clear. Second one is the availability of the money. Third one here basically that is the cost of money, clear, that is the cost of money or rate of interest, clear, that is the cost of money or rate of interest basically in order to attain, clear, or in order to basically get a set of objectives, clear, basically in order to attain a set of objectives basically oriented towards the growth and stability of the economy, clear, basically oriented towards the growth and stability of the economy, clear, basically these monetary policy, clear, this monetary policy basically help us to how to basically grow our economy and how to make it stable, clear, and how to make it stable, clear. So this is the process, clear. So this is the way, clear, basically how to make our economy, that is growth and stability of the economy, clear. All these things basically depends upon the monetary policy, clear. Basically monetary policy basically provides insight into how to craft optimal monetary policy, clear. Like we can say that there is high inflation or deflation in the market, clear. So basically how the monetary policy tools, clear, basically how the monetary policy tools basically help to control all these conditions, basically we have to discuss here regarding that, clear. Basically we have to discuss here regarding that one by one, clear. So monetary policy, clear, basically monetary policy, you have to remember that basically monetary policy is to be either as an expansionary policy, clear, it is to be either as a expansionary policy or it is to be as a contractionary policy, clear, or it is to be as a contractionary policy, clear, expansion policy or contraction policy, clear. So monetary policy, clear, basically here monetary policy is referred to as either being an expansionary policy or a contractionary policy. Clear? Basically, where an expansionary policy. Clear? What it means that increases the total supply of money. Clear? Basically, what it means that basically that is increasing the total supply of money in the economy, and a contractionary policy. Clear? Contraction basically means that basically we are squeezing. Clear? And that is basically decreases the total money supply. Clear? Decreases the total money supply. Clear? So expansionary policy, it is a traditionally used to, clear, expansionary policy is traditionally basically used to combat unemployment in a recession by lowering. Clear? Basically how? Basically by lowering the interest rate. Clear? Basically by lowering the interest rate. Clear? To combat the unemployment. Clear? So basically that lowering the interest rate so that basically more and more people basically will take the loan and start their work. Clear? And start their work. Clear? On the other hand, while contractionary policy basically involves raising interest rate. Clear? Basically when there is more money flow. Clear? Basically when there is more money flow in the market. Clear? Basically when there is more money flow in the market. Clear? Basically when there is more money flow in the market. Clear? So in that case, basically what it will do, basically they will increase the interest rate. Clear? So they will increase the interest rate basically for what? In order to combat the inflation. Clear? Basically for what? Basically in order to combat the inflation. Clear? So that is basically monetary policy. Clear? That is basically monetary policy. That is basically to control the money supply. Clear? Basically their main motive is basically to control the money supply. Next one. Clear? Basically next one, basically what we have to do, that is basically what is fiscal policy. Clear? Basically monetary policy is contrasted with the fiscal policy. Fiscal policy basically where it deals. Clear? Basically which refers to government borrowings, spendings, and taxation. Clear? So basically what is basically fiscal policy? Basically fiscal policy basically refers to the government borrowings. Clear? Basically fiscal policy basically refers to the government borrowings, spending, and taxation. Clear? So hope it is clear to all of you. Basically what is the basic difference? Clear? Basically what is the basic difference between the monetary policy and the fiscal policy? Clear? Basically fiscal policy basically refers to the government borrowings, spendings, and taxation. Clear? Basically it refers to the government borrowings, spendings, and taxation. Clear? So please tell fast it is clear to all of you regarding what is the basic difference between the monetary policy and the fiscal policy. Clear? Now basically we will move towards basically what are the different tools of the monetary policy. Clear? Now basically we have to discuss regarding the basically what are the different tools of the monetary policy. Clear? So first one here is to be the bank rate. First tool here is to be the bank rate. Second one, clear? Second one here basically we have to use the CRR, that is cash reserve ratio. We have to discuss in detail all these tools one by one. Clear? First rate is the bank rate. Second one is the cash reserve ratio. Third one is the SLR, that is statutory liquidity ratio. Fourth one is the MSS, market stabilization scheme. Fifth one here is the repo rate. Clear? Sixth one. Clear? Sixth one is the reverse repo rate. Last one, seventh one is the OMO. Clear? OMO basically stands for the open market operations. Clear? Basically OMO stands for the open market operations. Clear? Basically OMO basically stands for the open market operations. Clear? So basically these are the different tools. Clear? Basically these are the different tools basically which we have to discuss one by one. Clear? OMO basically open market operation. Clear? OMO basically stands for the open market operations. Clear? So basically these are the different tools. Clear? Basically these are the different tools basically which we have to discuss one by one. Clear? Basically which we have to discuss one by one. Clear? So basically first one is the bank rate, second one is the cash reserve ratio, third one is the SLR, fourth one is the market stabilization scheme, fifth one is the repo rate, sixth one is the reverse repo, and seventh one is the open market operation. Clear? Seventh one is the open market operation. Clear? So now let's start our discussion by one regarding all these tools. First one here basically which we have to discuss, that is bank rate. Clear? Basically bank rate. Clear? So let's discuss basically what is bank rate. Clear? So bank rate here also referred to as the discount rate. Clear? Basically, bank rate here basically also referred to as the discount rate. Basically, what is bank rate? Basically, that is basically the RBI lends money. Clear? The rate at which basically RBI lends money to the banks. Clear? Basically, to the banks. That is basically considered as the bank rate. Clear? So bank rate basically also referred to as the discount rate. Basically, it is the rate of interest. Clear? Basically, it is the rate of interest. Basically, which a central bank. Clear? It is the rate of interest. Basically, which a central bank charges on the loans and advances. Clear? Basically, bank rate it is also referred to as the discount rate. Basically, as the it is the rate of the interest. Clear? Basically, which a central bank charges on the loans and advances. Clear? Basically, where basically on the loans and advances. Basically, that it extends to the commercial banks and other financial intermediaries. Clear? Basically, that loan is to be given by the RBI basically either to the commercial banks or to the other financial intermediaries. Clear? So basically at the rate basically at which RBI clear basically charges clear on the loan that advances, that is basically known as the bank rate. Clear? Bank rate. Clear? So basically later on basically we will try to understand basically what is basic difference between the bank rate and repo rate. Clear? And repo and reverse repo. Clear? Because many students will confuse among between them. Basically, we have to understand also. Clear? So basically, changes in the bank rate. Clear? Basically, changes in the bank rate are often used by the central banks. Clear? Basically, changing in the bank rates basically are often used by the central banks to control the money supply. Clear? Basically, for what? Basically, to control the money supply. Clear? However, the role of the bank. Clear? However, the role of a bank as an instrument of monetary policy. Clear? However, the role of a bank as an instrument of monetary policy. Clear? Bank rate as an instrument of monetary policy has been very limited. Clear? There is not much role of the bank rate. Clear? There is not that much role of the bank rate basically because of these three basic factors. Clear? First one is basically the structure of interest rate is determined by RBI. Clear? They are not automatically linked to the bank rate. Clear? Basically first one, basically the interest rate. Clear? The interest rate basically which the bank charges from the customer basically are not linked to the bank rate. Clear? Basically are not linked to the bank rate. Clear? Second one here basically commercial banks. Clear? Commercial banks basically enjoy specific refinance facilities. Clear? Commercial banks basically enjoy specific refinance facilities and not necessarily rediscount their eligible securities with the RBI at bank rate. Clear? Commercial banks basically enjoy specific refinance facilities and not necessarily rediscount their eligible securities basically with the RBI at the bank rate. Clear? So the bill market. Clear? The bill market is underdeveloped and the different sub-markets of the money market are not influenced by the bank rate. Clear? Basically money market is also not influenced by the bank rate. Clear? So that's why basically the role of the bank rate. Clear? The role of the bank rate here is to be limited. Clear? The role of the bank rate here is to be limited. Clear? Now next one. Clear? I think all of you are able to understand basically what is the bank rate. That is basically the rate. It is also known as the discount rate. It is basically the rate of interest basically which a central bank. Clear? Basically which a central bank charges on the loan that advances. Clear? Basically which a central bank charges basically on the loan that advances, that it extends. Clear? Basically that it extends to the commercial banks and other financial intermediaries. Clear? So the next one basically which we have to discuss here. Clear? The next one basically which we have to discuss here, second one here, that is cash reserve ratio. Clear? Cash reserve ratio. Clear? Basically cash reserve ratio, it means that basically bank has to maintain. Clear? Like we can say that if there is 100 rupees in the hands of the bank, so bank has to maintain some portion of that with the RBI. Clear? Some portion of that rupees. Clear? That money with the RBI in the form of cash reserve ratio. Clear? We can say that if the cash reserve ratio is 4%. Clear? So basically out of the 100, 4 rupees is to be kept with the RBI. Clear? By the bank. Clear? 4 rupees is to be kept with the RBI by the bank. Clear? And rest basically they can use. Clear? Rest basically they can use. Clear? That is basically known as the cash reserve ratio. Clear? This reservation. Clear? Basically this reservation basically is done only in the form of cash. Clear? Basically this reservation is done basically only in the form of cash. Clear? So the present banking system. Clear? The present banking system basically is called fractional reserve banking system. Clear? The present banking system basically is called fractional reserve banking system as the banks. Clear? Basically here as the banks are required. Clear? As the banks are required to keep only a fraction of their deposit liabilities. Clear? Basically as the banks are required. Clear? As the banks are required basically to keep only a fraction. Clear? Basically to keep only a fraction of their deposit liabilities basically in the form of liquid cash with the central bank basically for ensuring safety and liquidity of deposits. Clear? Basically, why the banks have to deposit with the RBI? Because sometimes their financial condition of the bank is not good. Clear? So at that time, basically RBI will use that money to ensure the safety and the liquidity of the deposits. Clear? Basically to provide the money to the customers. Clear? To provide the money to the customers. Clear? So the cash reserve ratio. Clear? Basically the cash reserve ratio basically refers to the liquid cash. Clear? Basically it refers to the liquid cash that the banks have to maintain with the Reserve Bank of India as a certain percentage of the net demand and time liabilities. Clear? Basically cash reserve ratio is certain percentage of basically NDTL. Clear? Basically it is the certain percentage of the NDTL. Clear? That is basically the net demand and time liabilities. Clear? That is basically the of the net demand and time liabilities. Clear? So basically what will happen, first of all, basically this example basically we have already discussed, that is, for example, if the CRR is 10%, clear, so then the bank with the net demand and time deposits of rupees 1 lakh, clear, they how much money with the bank, that is 1 lakh, will have to deposit. Clear? Basically 10% of that, basically we can say that 10% of 1 lakh is to be 10,000. Clear? It is to be 10,000. Basically they have to keep with the RBI. Clear? They have to keep this basically with the RBI as a liquid cash. Clear? They have to keep this basically with the RBI as a liquid cash. Clear? That is basically known as the cash reserve ratio. Clear? So what is the impact? What is the impact basically with the cash reserve ratio? What will happen if the CRR, clear, here basically we will discuss regarding that. Clear? What will happen if the CRR is increased or CRR is decreased? Clear? Now basically we will have to discuss regarding that. Clear? Basically what will happen if the value of the CRR is going to be increased, and what will happen basically if the value of the CRR, clear, if the value of the CRR is basically going to be decreased. Clear? So how is CRR basically used as a tool of credit control? Clear? So CRR basically was introduced in the 1950 basically primarily as a measure to ensure safety and liquidity of bank deposits. However, what will happen? However, over the years, it has become an important effective tool. Clear? Basically, however, over the years, basically, it has become an important and effective tool basically for what? For directing, regulating the lending capacity of the banks and controlling the money supply in the economy. Clear? Basically, it is an effective tool basically for what? For directly regulating. Clear? Basically for directly regulating the lending capacity of the bank. Clear? How it directly affecting earlier? The bank has 100 rupees to lend. Clear? Now 4 rupees basically RBI will take. Clear? 4 rupees will RBI will take. Now only 96 rupees. Clear? Basically just for understanding. Clear? Basically we are using this type of example. Clear? So basically now only 96 rupees is left in the hands of the bank. Clear? Only 96 rupees is left basically in the hands of the bank. Clear? In the hands of the bank. Clear? So basically that is the thing they are saying here. Clear? So basically CRR was introduced in the 1950 basically primarily as a measure to ensure safety and liquidity of the bank deposits. However, over the years, clear, basically, however, over the years, basically, it has become an important and effective tool, basically for directly regulating the lending capacity of the banks and controlling the money supply in the economy. Clear? And controlling the money supply in the economy. Clear? So whenever the RBI feels, clear, when the RBI feels that the money supply is increasing, clear, that the money supply is increasing in the market, clear, that the money supply is increasing in the market, and causing an upward pressure on inflation. Clear? And causing an upward pressure on inflation. Clear? So basically in that case, basically what will happen? Basically it means that there is more money in the market. Clear? That is basically there is more money in the market. Clear? So basically they have to keep out. Clear? So they have to keep out some money from the market. Clear? So basically they have to keep out basically some money from the market. So basically how they will keep out? Basically that is less money is to be held with the banks. Clear? That is basically less money is to be held with the banks. So in what case basically less money is to be held in the banks? Basically when the CRR is going to rise. Clear? When the CRR is going to rise. Clear? So basically that in that case, the RBI has the option of increasing the CRR. Clear? Thus reducing the deposits available with the banks to make loans. Clear? To make loans, and hence reduces the money supply and inflation. Clear? And hence reduces the money supply and inflation. So please tell fast. It is clear to all of you basically how CRR is basically used as to control the liquidity in the market. How CRR is basically used to control the liquidity in the market. Please tell fast if you have any doubt, any query. These types of question, clear? Basically these types of question you will get in the examination. Clear? Like we can say that there is high liquidity in the market. Clear? There is high liquidity in the market. So basically how we can control the liquidity? Clear? Basically how we can control the liquidity by increase the CRR. Clear? Increase the CRR, decrease SLR, or second one basically increase both, clear, CRR, SLR, clear. So in this way basically they will ask these types of questions, clear. Just you have to understand the concept, clear. Just you have to understand the concept, and if you able to properly understand the concept, clear, basically if you are able to properly understand the concept, then you are answer the question, clear, then you will be able to answer the question very easily, clear. Now move towards the next one, that is SLR, clear. SLR, clear, basically here basically we will that is SLR, clear, statutory liquidity ratio, clear. SLR basically stand for the statutory liquidity ratio. So statutory liquidity ratio, clear, statutory liquidity ratio, basically it refers to the amount, clear, basically it refers to the amount that all banks, clear, basically it statutory liquidity ratio, basically it refers to the amount that all banks require maintaining in cash or in the form of gold, clear, that the all banks basically require maintaining in cash or in the form of gold or approved securities, clear, basically statutory liquidity ratio, like in the CRR, clear, like in the CRR, basically banks have to maintain certain percentage of their deposits basically in the form of cash, but under the SLR, clear, basically they have to maintain either under the form of cash or in the form of gold or in the form of securities, clear, or in the form of securities. Like we can say that basically bank has 100 rupees in their hands, so basically we will consider that 4% is going to the CRR, that is 4 rupees, so basically 96 left, and we can say that basically out of this also 20% is SLR, clear, basically 20% is SLR, that is statutory liquidity ratio. This ratio is to bank has to maintain with itself, clear, bank has to maintain with itself, not with the RBI, clear, like CRR basically bank has to maintain with the RBI, basically here bank has to maintain this, clear, basically bank has to maintain this basically with the itself, clear, basically with the itself, clear, not with the RBI. Okay, so hope it is clear to all of you, clear. Statutory liquidity ratio basically refers to the amount that the all banks require maintaining in cash or in the form of gold or approved securities, clear. So hereby approved securities basically we mean that the dated securities, that the government bonds and shares of different companies, clear. So basically here we will discuss regarding this one, clear. SLR basically 4% in the form of CRR, we can say that SLR is 20%, clear. So basically they have to maintain 20% with the bank with itself, clear, 20 rupees, clear. So 20 plus 4, 24 rupees basically they have to maintain in the ratio form, clear, basically as in the reserve, clear, as a reserve. So basically only 76 rupees, clear, only 76 rupees basically they have left to lend, clear, only 76 rupees basically they have left to lend, clear. So basically this statutory liquidity ratio, clear, this statutory liquidity ratio basically it is determined as a percentage, clear, basically it is determined as a percentage of total demand and time liabilities, clear, basically this is also determined basically as a percentage of total demand and time liabilities, clear, basically please remember that basically CRR is basically NDTL, net demand and time liabilities, clear. So basically statutory ratio basically this is as a percentage of total demand and time liabilities, clear, basically this statutory liquidity ratio basically it is determined as a percentage of total demand and time liabilities, clear. So time liabilities basically here refers to the time liabilities basically refers to the liabilities basically which the commercial banks, clear, time liabilities basically refers to the liabilities basically which the commercial banks are liable to pay, clear, that are liable to pay to their customers, clear, at on their anytime demand, clear, basically time liabilities basically refers to the liabilities which the commercial banks, clear, basically which the commercial banks are liable to pay to the customers, clear, basically to the customers on their anytime demand, clear, basically on their anytime demand, clear. Like we can say that basically whenever customer basically present the check at the cash counter, clear, so basically we have to pay that, or basically whenever customer brings the fixed deposit, we can say that of 20 lakh, clear, and they want to that basically they want this money, clear, some money they want to transfer this money in the form of RTGS, like we can say that 15 lakh basically they have to transfer in the form of RTGS, and the rest 5 lakh basically they will take a cash in the form of cash, clear. So basically we have to provide this facility, clear, basically we have to provide this facility basically to the customer, that is basically here they are saying that under the SLR, clear, that is basically liable to pay to the customer basically on their anytime demand, clear, basically the liabilities, clear, the liabilities basically that the banks are liable to pay, clear, basically within 1 month's time to the completion of the maturity period are also considered as a time liabilities. Clear? The liabilities basically that the banks are liable to pay. Clear? That is basically the fixed deposit which are maturing in the upcoming month. Clear? That are also comes under the liabilities. Clear? With that the banks are liable to pay basically within 1 month's time due to the completion of maturity period. Clear? Regarding what basically due to the completion of maturity period basically are also considered as a time liabilities. Clear? Are also considered as a time liabilities. So basically in India, clear, basically in India, basically Reserve Bank of India, clear, Reserve Bank of India basically always determines, clear, basically Reserve Bank of India basically always determines the percentage of statutory liquidity ratio, clear, basically the percentage of statutory liquidity ratio. So there are some statutory requirements basically for temporarily placing the money in the government bonds, clear. So following this requirement, basically the Reserve Bank of India fixes the level of statutory liquidity ratio. Clear? The Reserve Bank of India, clear, that is RBI, basically fixes the level of statutory liquidity ratio. Clear? So at present, the minimum limit of the statutory liquidity ratio that is set by the Reserve Bank of India, that is 0%. Clear? So minimum SLR, clear. Sometimes they will ask basically what is the minimum SLR, that is 0%. Clear? Earlier, I think this limit is 20%. Clear? I think earlier this limit is 20%, and later on basically in the year 2020, clear, basically I have checked, I think in the year 2020, clear, basically in the year 2020, basically this limit, clear, this limit is basically now minimum limit is a 0%. Clear? Now minimum limit is basically 0%. Clear? And the maximum basically which they have defined, that is maximum is 40% and minimum is a 0%. Clear? So there, what are the some reasons? Clear? So basically there are some reasons basically behind introducing statutory liquidity ratio. Clear? There are the some reasons basically behind introducing statutory liquidity ratio. The main objectives for maintaining the statutory liquidity ratio are as follows. Clear? What are the main reasons? First one is SLR. Clear? That is SLR is maintained. Clear? SLR is maintained in order to control the expansion of bank credit. Clear? Basically in order to control the expansion of bank credit, like we can say that if the bank is 100 rupees, clear, if the bank is 100 rupees, bank wants to lend basically all the 100 rupees. Clear? Basically bank wants to lend all the 100 rupees. So basically to control this expansion, clear, to control this expansion, clear, like we can say that out of the 100 rupees, clear, if there is 20% is the SLR, clear, 20% is the SLR. So basically 20 rupees goes under the SLR. So basically only 80 left, clear, only 80 left for the lending, clear. So that is basically statutory liquidity ratio is basically maintained in order to control the expansion of the bank credit, clear, in order to control the expansion of the bank credit by changing the level of the statutory liquidity ratio, clear, basically by changing the level of the statutory liquidity ratio, Reserve Bank of India basically can increase or decrease the bank credit expansion, clear, if they decrease the value of the SLR, clear. So basically we can say that basically they will get more amount to lend, clear. Similarly, if they will increase the SLR, clear, so basically they have left less amount in their hands to for lending, clear, basically less amount in their hands for lending, clear. So basically statutory liquidity ratio, we can say that in a way basically ensures the solvency of the commercial banks, clear, ensures the solvency of the commercial banks. And by determining, clear, basically by determining the statutory liquidity ratio, clear, basically by determining the statutory liquidity ratio, basically Reserve Bank of India in a way compels the commercial banks, clear, Reserve Bank of India basically in a way compels the commercial banks basically to invest in government securities like the government bonds, clear. So basically, as basically we know that basically statutory liquidity ratio, basically the banks have to invest some in the form of the cash, in the form of gold, or in the securities, clear. So basically this SLR basically intends or basically forces, we can say that the to invest, clear, basically forces or compels the commercial bank basically to invest in the government securities, clear, like we can say that the government bond. So please tell fast, it is clear to all of you regarding the SLR, basically CRR, clear, what is their main role, clear, what is the main role, clear. Most of the time, clear, basically most of the time basically we will get question, clear, basically most of the time basically we will get question from the CRR and SLR, clear, basically what is the impact on these things, clear, basically what is the impact of these, clear. Next one basically we will have to discuss, clear, basically today I will not discuss that thing, basically I will tell you basically in the next session basically we will discuss regarding the market stabilization scheme, clear, very short topics, clear. Next one basically we have to discuss that the repo rate, clear, basically it is the rate basically at which the RBI lends short-term money to the banks, clear, basically short-term money to the banks, clear, that is basically RBI lends money, clear, our RBI gives money to the banks, clear, that is basically known as the repo rate, clear, that is basically known as the repo rate, clear. So what is the difference between the bank and repo rate? Basically under the here under the repo rate, basically that it is given as a short term. Clear? Duration is a short term. Basically, we can say that short term basically here means that that is less than 1 year. Clear? That is basically less than 1 year. Clear? That is basically known as the short term. Clear? Similarly, reverse repo. Clear? Reverse repo basically it is the rate. Clear? Basically it is the rate basically which basically banks will give money to the RBI. Clear? Basically bank will give money to the RBI. That is basically known as the reverse repo. Clear? Basically just for the understanding. Clear? Reverse repo rate, it is the rate basically at which the banks park their short term excess. Clear? That is also repo and reverse repo. Clear? Basically both are short term. Clear? So the reverse repo rate, it is the rate basically at which the banks park their short term excess liquidity. Clear? Basically park their short term excess liquidity with the RBI. Clear? Basically with the RBI. Clear? The RBI uses the tool. Clear? The RBI basically uses this tool when it feels that basically there is too much floating in the banking system. Clear? Basically when there is more money in the banking system, so basically at that time, clear? Basically at that time, basically RBI will use this tool. Clear? Basically RBI will use this tool or take the funds from the banks. Clear? Or take the funds from the banks. Clear? So that is basically the role of the repo rate and reverse repo rate. Clear? That is basically repo rate. Basically that is repo. Basically we can say that the repurchase rate. Clear? Repurchase rate. Clear? It is the rate basically at which the RBI lends short term money to the banks. So when the repo rate increases, clear? So when the repo rate increases, that is basically we are taking loan from the RBI basically at higher interest rate. Clear? So basically if the RBI gives lends money at 8.76%, so basically the banks will lend at 8 to 9%. Clear? And if the RBI basically gives money at 4 or 5%, the banks will given at 7 to 8%. Clear? So it depends. Clear? If the repo rate is high, it means that the interest rate is more in the market. Clear? So basically it is difficult to borrow money. Clear? Or it is expensive to borrow money from the banks. Clear? So that is basically known, that is basically termed as the repo rate. And that is second one, basically when the banks park their excess money basically with the RBI, that is basically known as the reverse repo. Clear? That is basically known as the reverse repo. Clear? Basically some other basic points basically we have left in that. That is first one is the fiscal policy and second one is the FRBM Act. Clear? That is FRBM Act. Clear? So basically we have to cover all these points in the tomorrow session. Clear? In the next session, and along with that basically we will try to discuss some MCQs in the tomorrow session. Clear? And tomorrow basically we will complete that topic. Clear? Tomorrow basically we will complete that topic. Clear? So hope it is clear to all of you regarding all these points. Very easy but technical questions. Clear? Very easy and but technical questions will be formed from this chapter. Clear? Basically will be formed from this chapter. Clear? So thanks to all of you for joining this session.